This is the third in our series of videos in constructing a master budget. We continue to use the problem from the textbook involving Santiago pants. We have, in the prior videos, completed a production budget and then a product cost budget. A product cost budget allowed us to budget material purchases, direct labor, and variable and fixed manufacturing overhead. Next, we're going to work on our budgeted statement of cost of goods. This is necessary so that we can produce a projected or pro forma income statement and a pro forma balance sheet. So we'll begin putting together our budgeted statement of cost of goods, and the first thing we want to do is indicate the number of units that we're going to produce, and again we go back to our production budget for that. To reference a different tab, I begin by putting the equal sign, and I'll go over to the production budget, and I'll go up to cell B10, reference cell B10, then hit enter, and we have now referenced a cell on a different tab. Again, this allows us to do sensitivity analysis. We can quickly change a number in our production and it will flow throughout our worksheets. In our cost of goods statement, we're going to first determine the amount in dollars of the direct materials that we used in the products that we sold. In order to do that, we need to look at our beginning inventory in dollars plus the purchase in dollars less what we anticipate having left over. So here we're only going to be including the material that we used in the production. To that we'll add in our other product costs for direct labor and manufacturing overhead that consists of both fixed and variable. That will give us our total manufacturing costs. We're going to need that to determine the cost of goods sold, taking into account the beginning inventory we had less the value of our anticipated ending inventory. In this company, each unit that is begun is completed within the period. There is no work in progress. This is a standard budgeted cost of goods statement where if a company did have work in progress, we would include the beginning and ending. Here it's not going to come into play, so we've entered zeros. The value for the beginning finished inventory, which if you remember is 5,000 units, are based on the prior period's budget, the cost per unit from the prior budget, or the actual cost accounting records, depending on when we are putting together this budget. If the actual cost accounting records are available, we'll use the actual amount. If we're using a prior period budget, we'll make a estimate. All right, so let's begin putting our budgeted cost of goods statement together. We're going to need to begin with the dollar value of the beginning inventory. If we go back to our production budget, we see that we had a beginning inventory of 10,000 units, and we have a cost of $3 per unit for cotton, 1,000 yards at $5 for fine cotton. So we need to put that in dollar amounts, so we're going to set up a formula, and we're going to need to multiply the number of yards in the beginning inventory by the cost. So we begin by putting the equal sign and then opening the parentheses, going over to our production budget, and clicking on the beginning inventory for cotton. We're going to multiply that by the cost per yard, and then we're going to do the same thing for our fine cotton. So we'll close the parentheses, put the plus sign in, open up parentheses, and we're going to reference the cell with the number of yards of fine cotton, multiply that by the cost per yard. And again, this is an estimate. If we were doing the budget after the completion of the prior period, we would use the actual cost accounting records to determine the value of our beginning inventory. But here we're going to use this estimate. So we have beginning inventory of 35,000. We have budgeted out our purchases. So again, we're going to reference that cell in our production tab. We are going to purchase both cotton and fine cotton. We budgeted $1,715,000 in total. We're going to need to determine the ending inventory in the same manner we did the beginning inventory. So we'll place our equal sign. We'll go over to production. We anticipate having 15,000 units in our ending inventory with a cost of $3 per yard for our cotton, plus 1,000 units of fine cotton at $5 per yard. So our total direct materials is our beginning inventory plus what we purchased minus our ending inventory. And this will give us the dollar value of the material that went into the goods that we sold. We will be leaving out any of the costs that's associated with the ending inventory and raw material, plus any material that has gone into units that are still in inventory. And so we'll take our direct labor cost next. And for our manufacturing overhead, we have our variable. Again, we'll go back and reference our production of 136,000 for variable, plus our fixed of 544. And now we can add up our product cost, direct material, direct labor, manufacturing overhead, and we have total costs of $4,250,000. We can now determine our budgeted manufacturing cost per unit. We'll take the manufacturing cost, divide it by the number of units we plan to produce, and we have a total cost per unit of $25 per unit. All right, so next we're going to calculate our cost of goods sold. Again, we have no work in progress, so our cost of goods manufactured will be the $4,250,000. Again, we have estimated our beginning finished goods inventory, the 5,000 units we have at the beginning of the period, to have had a cost of $120,000, and our finished goods we estimated to have at the end of a period, our desired amount is 15,000 units, and we're going to multiply that by our budgeted cost per unit. So we're anticipating that our finished goods inventory of 15,000 units will have a value of $375,000. So now we're going to use our standard cost of goods formula to solve from our inventory. We take our beginning inventory, we add in the cost of goods manufactured, subtract out the finished goods, and that gives us our cost of goods sold of $3,995,000.